I want to welcome you to this virtual town hall on the impact of COVID-19 to business valuation. And I'm excited to spend some time with you today. Let me introduce myself briefly. My name is Jonathan Jackson, and I'm the Executive Director at NACVA. And I'm here to kick off this discussion, this important discussion on that affects everybody that's attending this call today. And I'm really excited to have the Maryland, DC State Chapter, the NACVA State Chapter, a part of this virtual town hall today. And I'll introduce the State Chapter President here in just a moment. A little shout out to my friends in DC, Maryland. You see I have the Washington Monument right about there, right behind me. So I feel like even though I'm tying in from headquarters in Salt Lake City, which is a beautiful spring day here in Salt Lake City with some snow-capped mountains, my heart's there with you and in the greater Washington, D.C. area. I spent about a dozen years in Washington, D.C., working for presidential administration and also over the U.S. Chamber of Commerce, working on policy and some lobbying efforts as well, and got into the tech industry here in Salt Lake City. That's what brought me out west. Some of you may not know, but the tech industry here in Salt Lake is booming. It's one of the fastest growing tech hubs in the country. And so I ran the Tech Association here in Salt Lake, and we're also known as Silicon Slopes. I don't know if you've heard that term before. Silicon Slopes, shout out to our ski slopes here in Salt Lake City. As we get started today, I'm going to go over a few announcements with you. But this is some trying times, and I'm so happy that your president, state chapter president, Achille Q, put together this virtual town hall. Achille has been the state chapter president for a few years now, and has just done an excellent job. And us at headquarters talk about the DC Maryland chapter frequently and how active all of you are in the chapter and the good things that you're doing there. And these are uncertain times right now, and trying times for all of us. And this global pandemic has really hit our communities hard, and it's really hard to believe how much our day-to-day life has changed over the past 6-7 weeks. You know, I commute about 45 minutes to the office, and I started actually missing my commute after a few weeks of being stay-at-home orders. I was missing my long commute through the Park City mountains, and even things like going to the dentist I was kind of missing, you know, which is crazy to think that life has changed so much in the last 6 or 7 weeks. And I know this global pandemic has hit all of us in different ways, personally and professionally. And so I want to extend my best wishes to all of you, hoping that you're staying safe, staying healthy, and also staying kind to those around and helping others in need. These are unsettling times, and hopefully what we cover today will bring some information to you that is helpful to guide us and navigate us through this trying time. And so that said, first I want to thank our HQ staff, Wendy Caius, for helping us today on this webinar. And I also want to thank Achille Q for moderating this discussion. Achille has 20 years experience in the industry, and he has a passion for helping small business, and he is holds his MBA and also holds the Certified Valuation Analyst, which is the only accredited valuation credential on the globe. It is the only accredited credential out there dealing with business valuation, really in the financial services industry, which says a lot to the quality of that credential. And Ashil has just done an excellent job, and he really cares about everybody in his state chapter. And I just want to highlight, he not only is a public speaker, but he's also an author. Here, my bookshelf right next to me, I have his book, which I'm sure some of you have seen, which is a great read. I pulled this out, and I'm not a business valuator, but his book is an easy read where I can actually understand the industry, and I've really enjoyed reading it. So check that out. But with all that said, Ashil will go through the agenda with you here in just a moment. Before I turn it over to him, I just have a couple announcements for the group. So during these uncertain times, we are doing just a lot at NACVA to help our members be successful and to navigate through this crisis. And one of the things we've done, we've hosted other virtual town halls. We've hosted a number of free events, public service events that are free, and we're offering CPE credit for these. We want to be as helpful as possible to our members. And so you see this web address here. This is all of our activities that's going on related to this pandemic. And all of our offerings, our webinars, town halls, it's an entire schedule that's happening over the next several months. So please go to this website and check that offering. And also, one of the easiest ways to follow what we're doing is to get on LinkedIn and follow our company page. If you get on LinkedIn, search National Association of Certified Valuators and Analysts, it'll pull up our company page. You just hit follow, and then you will get our feed of all of our activities. And so that will keep you up to date on everything that we're doing. And then the other announcement I want to share with you is we've had to shift on what we're doing here at NACVA. We've had to pivot based on a live conference that was happening in June to a virtual conference that's now happening in June about the same time. And we are really excited about this virtual conference. It's happening June 15th through the 19th, and we're going to repeat the same conference live August 3rd through the 7th. So it's going to be 5 days instead of 2. And we have so many excellent presentations, and we're offering the state chapters some bundle packages. If you don't want to register for the entire conference, which we encourage you to do, if you just want to take a few of the sessions, we're going to offer a bundle discount, and Ashil will be in contact with you regarding those specials. There won't be a special for the entire conference. You can go on and log in today and register for the entire conference. But if you are interested in like a 3 or 4 session bundle, we will be offering that through the state chapter, and Ashil will be in contact. So there's information about our conference on our website. It's not just going to be a series of webinars. It's going to be a live interactive networking like you're there as best we can, and it's going to be a really cool event. We've done a lot of work to shift it to this, and there'll be opportunities to see your colleagues, friends, and interact with them. So please take note of that. All that said, I want to thank again Ashil for putting together this excellent panel and this excellent agenda today. And I'm going to turn the time over to him. Ashil, welcome.
Thank you, Jonathan. Thank you so much for that fantastic introduction. You're going to make me blush, buddy.
It's well deserved, my friend, well deserved.
Right. So I am a servant of the people. So I always try to give the best. And this is also what I'm doing here. And I appreciate anyone who appreciates the work that we're doing. And I just want to emphasize that I'm not doing it by myself. I have a team behind me that I'm going to thank as we go now. So I want to thank my board, my local board. That includes Angela Dimitrieva, she's our secretary, Neil Eisgruber, our treasurer, Courtney Moore, our vice president, and myself as the president of the state chapter. So what we're going to do at this point is introduce our panelists, and each panelist is going to get about 2 minutes to introduce themselves and say a welcome word or any opening statement that they may have. So without further ado, we're going to start with Alan Zip. Alan.
Oh, well, thank you very much, Ashil. This is a wonderful opportunity for all of us, including the participants out there, to get some ideas from our perspective. And we're the same as you. We just happen to be asked to do this on TV. My background is in the legal side, and I do a great deal of litigation support work. And I'm going to talk today focusing on how we're going to communicate in court to a judge. And I'm going to come back to this credibility question and whether we're going to be able to come to an opinion of value for the court to a reasonable degree of certainty, whatever that means, certainty, in this environment. And we're going to talk a good deal today. You're going to get everybody's perspective on how we're going to do our valuations going forward. One of the issues that I'm concerned about too is the cost to the client and whether we're going to get paid for all this additional time that we must spend in order to do the job in a credible way. And so we'll talk about that too. But my background, I'm a CPA, I'm an attorney, certified business appraiser, certified business analyst, I'm a fraud examiner, and I'm ABA or ABV for the AICPA. So I'll go on to the next one. Thank you very kindly.
Thank you, Alan. Cheryl Hyder.
Sorry about that.
Yeah.
Hi. Well, first, again, thank you, Michelle, for inviting me to join your panel. There's a bunch of incredible knowledge up here, and I'm flattered to be asked. You know, situations like this that we're currently facing were unfathomable years ago when I was first credentialed. Brief background, I've been doing forensics and fraud examination for over 25 years, valuations for 15 or more. And from everything I've seen before till now, I would say the upside to it all is probably, and there is an upside, this reinforces something that NACVA says. NACVA tells you at your very first class, very first thing out of the speaker's mouth, which is it's super important to have a solid understanding of the fundamentals. If you can't have that, you don't want to be an evaluator. And that's because of situations like this. We're in, I'm not going to say unprecedented times, but we're facing some interesting challenges right now. Availability of information, doing a credible job, being certain or not about what you're doing and what your conclusions are. And if you don't have a solid understanding of the fundamentals, you're not going to be able to do that. That's basically all I have. Do it right, be credible. Thank you.
Thank you, Cheryl. It's David Jones' turn now. David.
Good afternoon, everyone, and I guess good morning to those you on the West Coast, but I don't think we're pretty much mostly local today. We're in a situation where we're going to be incredibly challenged. We've all been brought up with the idea that valuation is an art and not a science. And in the several years which follow, we're going to have to exercise maximum creativity as artists. Historically, we've looked at the past as an indicator of the future, but we entered in March a very different world than we had in February. Because we cannot entirely look to the past, we may want to look to the future, but the future is going to be much less predictable than it's been historically. Will we get a vaccine? If we get a vaccine, certain industries are going to benefit. If we don't get a vaccine in the near future, will it keep the value of many types of businesses down for years to come? This is going to be a very trying period for valuators. It is also going to be interesting, and we're going to have to be at our professional best.
Thank you. Thank you so much, David. Another David Witherspoon.
Great. Thanks, Ashiel. Appreciate it. I run the valuation practice at Katz Abosch. I've been at the firm for, I guess, almost 10 years now, maybe 9, with a pretty heavy focus on litigation support, to include bankruptcy services, bankruptcy and restructuring work, which I suspect we'll talk a little bit more about, M&A consulting, and of course, traditional appraisals for tax and financial reporting as well. The COVID-19 pandemic has certainly had a very wide array of impacts on businesses. And what I mean by that is that we've already noticed and seen a pretty wide disparity between some businesses that are actually positively impacted to companies that are probably, frankly, already dead, and everything in between. I think it's going to be incumbent upon us as appraisers to assess that industry by industry and company by company as we move forward with our clients' engagements. It also, when we have wide impacts on valuation like this, it also leads to some different shifts in the types of work that we see our clients coming to us for. I've looked ahead in the questions, and I don't think, Ashiel, this is one of the questions, but types of work that we see moving forward, we see things like bankruptcy restructuring work, gifting, and S elections. Anywhere where we can pick a valuation date and we want a low valuation date, we see those services as probably increasing in need. And we see some areas that are probably going to decrease in need, perhaps in the merger and acquisition world, and charitable contributions as values are largely down. With that, I look forward to hearing what everybody else has to say, and I look forward to participating as we move forward with the program today. Thanks.
Thank you, David. Thank you, David. We're certainly going to touch up on what you just mentioned there. So just be patient. All right. All right. Next, Ron Rudish. Ron.
Thank you, Ashiel, and
Yes.
thank you everybody for attending today. As everybody has said, that Cheryl had mentioned fundamentals. David had mentioned some specific types of business valuations are going to be requiring a lot of effort on our parts. I want you not to forget to go back and reread maybe a couple times 5960. We're still rooted in our standards. We're still rooted in 5960 and following those factors. May 1966, 54 years ago, I began in accounting. And I've seen a lot of things from polio affecting lifestyles to other diseases, and even as a youngster seeing in the 50s when we had our first recession. But nothing, this is like ice water in our faces as to what do we do? How do we handle it? What research do we have? And we're going to have a problem with the transaction database is all historical, and we don't have anything or enough information to give us guidance if we're using a market approach. If we're using the income approach, how much credence do we put on a DCF? Well, a client, even with our help, understand and know how to put together a DCF. And then once we're able, if we can rely on that, what kind of discount rate and cap rates will we utilize throughout that process? hopefully as possibly risk diminishes and a lot of companies get back on board. David mentioned bankruptcies already. I'm working on 7 of those. Divorces, I believe, which happened after Lehman Brothers in 2008. We were doing a lot of divorce work back then as well because business values went down and the in-spouses found that they could settle with out-spouses for much less. Whether you're a generalist or a specialist, I need for you to really take care, and the word was mentioned several times already, credibility. It's all about that. I would offer that more than ever, I think we need to prepare a representation letter and have our clients sign off on that as to their understanding of what was done and their enjoining with us and understanding how the process for business valuation process occurred. Thank you.
Thank you. Thank you so much, Ron. Okay, so let's get right into our Q&A session now. For people listening to us out there, you're going to see some poll questions appear in front of your screen. Just make sure you answer those if you're looking to get the 2 CPA credits. Okay, so let's get right into it. First question. When do we start considering the impact of COVID-19 as a subsequent event in evaluation?
Wouldn't that be a fact-specific question, though? Depending on who the evaluation subject is. You have a company that's in medical research. They're going to be aware of it a whole lot sooner than, say, a retail shoe store, right? Wouldn't they? So
You're right. I think it definitely would be more industry specific.
Yeah, I mean, you're talking about, I think, a situation where if the tree falls in the woods and there's nobody there to hear it, the tree still fell. So when did you become aware? You have to actually look at the bones behind what's being valued. And when should it have been known or knowable from, through their lens?
Yeah, and I think I take a somewhat empirical look at this. I think there's 2 things that I've noticed out there. The first is that there are a number of sources where some folks have listed out a sequence of events leading up for COVID-19. I think people can find those just by searching Google, for those timelines. I found those really helpful. But for me, the number 1, 2, and 3 thing that I'm going to go to in terms of when was the impact of COVID-19 known and knowable from a market participant perspective is just take a look at the S&P 500 index timeline. Take a look at NASDAQ, or really the Dow Jones timeline, and it seems pretty evident to me that February 29th of 2020 was a pretty critical day from the perspective of when things really started being devalued hard. And I think it's going to be, difficult. I certainly would in court. I'd love to have that chart up if somebody picked a different date, because it really just shows a very dramatic drop off after that. But I do think that it is very fact specific, case specific. When things were known or knowable to you. I think going forward, it's also going to be very specific on geographic locations. I think as outbreaks pop up in specific areas, local businesses, medium and small businesses in that area may be very impacted, while medium and small businesses in other geographic footprints, frankly, aren't impacted at all. So I think going forward, we're going to have to pay very particular attention to how each local geographic region is also being impacted.
But very generally speaking, most of our valuations are willing buyer, willing seller. I think the impact really hit the second week in March. Now, on most valuations, the exact day may not make a difference. I'm a sports fan. I was flying to Indianapolis to watch the Big Ten basketball tournament that second Wednesday in March, and I'm packing, and I get the word first that it's going to be without fans, and of course the next day it was canceled. I think that's when it hit a lot of people in America, the night that sports shut down. But many of our valuations are done at the end of a calendar quarter. By December 31, 2019, very few people thought that what was happening in China in the earliest cases would affect us. But certainly by March 31, we had a new world.
Absolutely. I think if you look at the timetable to what both Davids were talking about, the president on March 13th declared a national emergency. And also what David was saying with regard to the market as of March 1st really started to decline. Prior to that, we had different highs on the Dow Jones, S&P 500, and in the Russell 2000. So ultimately, we had across the board 29% decline in Dow, 27% in the S&P, and the Russell 2000 was a whopping 37% down. But
Go ahead.
no, go ahead, Cheryl.
I was just going to throw in there to David Witherspoon's point of February 29th, we've got the Fed cutting rates on March 3rd, which is not to be confused with, economic advisors on February 25th saying, no, the economy will be fine.
Right.
So, I mean, they started talking about the stimulus package the end of February as compared to the first package being signed and sent the end of March.
So let's go back 1 second.
Okay.
A lot of people have been asking us at December 31, 2019, should we be taking the coronavirus into context in a business valuation? And I believe we're all in agreement. The answer is no, because it really wasn't known or knowable at that time.
Correct.
But going back to what other people were saying earlier, it is still an art. Whether you're going to pick it up maybe late in February or definitely by the end of March, I think, yes, that we have to do.
But Ron, the issue is also whether that subsequent event should be disclosed. While we're not going to take it into account in the valuation at the end of December, we do recognize that it has a major effect on that particular business. And so the question then, I think, is important. Should we disclose it, and how should we disclose it? What should we say?
I have illustrations of that, which I can, from SSVS1 last week, the AICPA put out a notice and guidance and suggested wording for our reports in that instance.
Right. That's the
So,
tool.
I'd like to point that out in the toolbox that the AICPA published. There is some very good language because we've already identified about 3 or 4 different dates. And the question then is, how significant is that date for any particular purpose? And what I do like the AICPA language that talked about, well, here's a whole series of dates that make reference to knowable. But my point here is that should we talk about it, and if we do, I think we should use that kind of language that here's a whole series of dates. And if you want to take one of them and say that makes it definitive, then do so if you can support it. But otherwise, just the information, I think, is adequate.
All right. Thank you, guys.
I want to dovetail on that, Alan. The toolbox was relating to specific words that it shouldn't be in our report, should be set aside after the report to make our users know that. Or you can put it in your assumptions and limiting conditions as well to put the public on notice that you're aware of it, but it didn't have any meritorial conflicts or changes to your valuation at the date.
that's a critical point, Ron, because our report, the valuation date is set. And if it was not known or knowable on that day, then it should not affect the value that we opined in that report. If you want to give the additional information, which I frankly think is very important, then do so. But do so as a generic statement that this may have an effect, but it doesn't change the value on that date.
All right. Thank
One
you.
additional thing, let me just throw this in and then I'll put it to bed.
All right.
The toolkit is also, it delineates that if we're going to raise this issue, we have to be clear in terms of other issues that we may not be raising, just to ensure that there's no appearance of bias in your report. You want to just make sure that, you know, you evaluate whether there's other subsequent events that may or may not be impacting the company. So if you disclose this but don't disclose that, where's your bright line?
All right.
Yeah.
Let's move to the next question. Thank you. So what's the effect of COVID-19 on each method of valuation, particularly when it comes to capitalized cash flow, the assets method, and as regard to the market method, are comparables worth anything today? And with regard to the income method, is the DCF the most appropriate valuation method to use now?
I think that you must try to use DCF, which is going to be, as Alan mentioned, a lot more work and a lot more fees for the client. You cannot count on the prior years in most, not all businesses, being indicative of the future, and you can't count on the comparables as you look back even 5 years being a good source of what the business will go for. I think we are going to have to move toward DCF in more valuations.
But along with that, I think we're going to have to pay special attention to the company-specific risk and the cash flow. And we're going to have to make special attention that we do not double dip. That if we are adjusting, and I'm not sure even how to suggest that the cash flow should be adjusted relative to COVID, but then again, there has to be more thoughtful analysis to the risk of the company at that moment. If we're in a COVID time period, let's say after March 29, then again, that we're not double dipping, that we're hitting the risk portion of the cash flow, but also again in the company specific risk.
Jonathan,
Yeah, something just popped up on my screen. I don't know if we can get rid of that, but
I just
Ron made a point.
highlighted the question we're on because it's a little tough to follow the question. Sheila, are you okay with that if I highlight the question so people know what's being discussed?
okay,
But that takes up the whole screen, John.
takes up the screen. Yeah, I think.
That's not as important. I mean, we're going to come to each of these items, but
Great.
Yeah.
I wanted to embellish on what Ron said about the double dip question. I'm not so sure that double dip is a bad thing in concept, because the cash flow projections are subject to a great deal of subjectivity and a lot of unknowns, of course. And then our risk factor is pretty high. So I'm not sure that that is a bad thing to double dip by putting in a higher risk element for the cap rate, as well as making sure that you're conservative in your cash flow analysis.
Well, I agree, but I will make a caveat to that. I think we all do a lot of small businesses, maybe under 25 million in revenue. From my perspective, I'm thinking, I have one client in North Jersey. He delivers water. He is busier than ever before because people aren't leaving the house and they're afraid to go get bottled water. So there are many businesses we know, I heard this morning, that are closing, and some don't even know how they're going to start up. So using those words, Are we to consider them a startup or early stage, even though they have a history? And that is additional risk that you, Alan, you're correctly stating that we have to take into account.
Yeah, Ron, I'm not here to plug in a different organization. I know we're all very big fans of NACVA, but the AIRA, Association of Insolvency and Restructuring Analysts, does have a very different curriculum. And they have two different designations, the CIRA and the CDBV. The second is the Certified in Distressed Business Valuation.
Yeah, familiar.
And I took those courses and they're actually pretty good, but they talk a lot about valuing businesses that are in distress, like you said, almost like they're a startup, and using like venture capital type of rates of return on them. And I think as we move forward, there are going to be plenty of situations where that comes into play. And I think there's going to be lots of situations, not only where these methods don't necessarily apply, but the whole premise of value as a going concern doesn't apply. We typically begin most of our business appraisals with the presumption that the business is a going concern. And I think there's going to be lots of situations where we just look at it and say, this business is insolvent. It's worth more dead than alive. I could value it as a going concern, but frankly, it's worth more under orderly liquidation. And I think that's going to be something that we have to consider.
Right.
I think specific, I'm sorry, go ahead.
No, go ahead. I'm sorry.
I was going to say, Ashil, specific to your question about the different methods, I think it may be helpful just to sort of break each one down a little bit more. Capitalization of benefits method, real simple formula, everybody knows it. Next year's cash flow divided by discount rate minus long-term growth rate. Candidly, that everybody knows that method is most beneficially applied in a scenario where you have a sustainable and predictable long-term growth rate, and next year's cash flow is reflective of the average business cycle for that business. I don't think anybody on this panel would think right now, and I don't think anybody out there right now thinks that next year's projected cash flow represents for any business the long-term forecast for that business.
You're right.
And certainly we typically look at historical financials to be indicative of future expectations. And I don't think for most businesses out there, that's a true assumption anymore either. And the final component of it, so that's cash flow on the numerator and the discount rate or the long-term growth rate on the bottom. The discount rate is always commensurate with those cash flows or with that growth rate. And because you don't know cash flows or growth rate, it's pretty darn hard to peg the appropriate discount rate to apply to them either. So I think the capitalization of benefits method, unless you're one of those few companies that just really has had no impact by COVID, I think the capitalization of benefits method is going to be hard to justify applying. On the DCF, I'm a huge fan of it. I'm probably biased in thinking that it's the way to go in the future because I've always frankly felt that it's the way to go. But I am seeing several clients now ask, well, what type of forecast do you need here? And frankly, we're looking at multiple forecasts, whether COVID and the economic shutdown lasts 3 months, 6 months, a year, 2 years, because the quantitative impact of those different assumptions lead to very, very different present values. And then probability weighting the impact of those scenarios. The nice thing about doing a multiple scenario DCF like that is that your discount rate is now able to be a little bit more of a traditional discount rate because you're probability weighting the impact of COVID in discretely in your multiple scenario DCFs. The downside is it's a pain in the butt. You've got to have a client that's willing to put together 3 or 4 discounted cash flow models going out on the different assumptions, maybe 4 or 5 years on these DCFs, and that's a heck of an exercise for a lot of businesses to go through. So I'll stop right there because I've been talking for a while.
I'd like to, David, if you go further with that, on our small business clients, they have no clue on how to do a proper forecast. We have to do forecasting and the projecting. And I'm curious what you think of this concept. We put together an Excel model and we just keep changing the numbers. The real question is, what is the probability that each or any one of these is going to be realized? How do we develop that with any degree of credibility and supportability we can do multiple analyses of cash flow. That's easy. But how do we then determine the probability that any one of these is going to be realized? What do you think of that?
No, I think that's a great question. And I think that's also industry specific, right? So industries that are likely to have long-term or long tail impacts of this, you may more heavily weight the scenarios that show a longer term impact. But in terms of, when's a vaccine going to be created? I mean, I don't know. I don't know the answer to that, obviously. And that would impact a lot of these financial forecasts, right? When is the casino going to reopen? I chair the finance committee down at the Lyric downtown. When is the Lyric going to be able to open its doors again? I mean, I don't know that. You don't know that. The bank doesn't know that. And here's the serious problem for us as appraisers, speaking of our risk, is the IRS says if they find that we've grossly misvalued anything, we can be penalized. And we got to put a value on these things that people do and are doing gifts. If the IRS comes back and says we used the wrong assumptions and it materially misvalues the finding, boy, that now that 50% or 40 to 60%, level of gross or misvaluation doesn't sound so good, or in the past.
David, let me ask you a question. Senior moment, it just fleeted out that quickly. Do you think that the years in a DCF are going to be more than 5 now?
I think again it depends on the case, right?
I think it depends on the business and the industry.
Yeah.
And I think we have another problem with regard to the WAC and how we utilize that, because companies may be picking up more loans and debt, and how do we account for that, and the reasonableness that the company will be able to outlive the debt.
I think WAC is a really huge problem right now because
yes.
You may discreetly project cash flow to invested capital. The question is now, what's the ideal capital structure for the industry? Can you really go to Duff & Phelps industry cost of capital book and look at what the public companies were getting for their capital structure and apply it to even a large mid-sized company anymore who may not be able to go to their bank and get that capital? Bank lending is tightening up. I mean, for PPP, they'll give all the money away for free because the government's sort of backstopping everything. But
those rules are changing daily,
right? And go try to get a.
It sounds like we all agree that DCF, which historically has been the best method to utilize, but it required so much more work that most of us didn't use it if the past was indicative of the future. So we got to use DCF in many circumstances, but it is so much harder to quantify the probability of certain events happening, but it may still be our best method of proceeding.
Absolutely.
Well, David, wouldn't that be something to discuss with management? Because at the end of the day, management has to, at least in my view, feel comfortable that, yes, this is my most likely scenario. This one is a Hail Mary, and this one is somewhere in the middle. And you're not, I don't think it's incumbent on the evaluator to come up with those probabilities. I think it's more something more properly determined by the client.
I think the client has the first stab at it, but we must use our own professional judgment. Is our client being credible, particularly in a matrimonial matter where one day they tell the bank they have a $2 million company and the next day they tell their divorce attorney that it isn't worth anything?
No, I'm not suggesting at all that it's just, hey, no, the client said this. We've all seen that case. We've all been there, saw the movie. What I'm suggesting is we need to bring them, I'm doing this right now in 2 gift tax valuations, I'm bringing the client the research and saying, these are what I'm seeing as a result of my research. How do you think this is going to play out? What assumptions would you change from a past projection to one that you're preparing now on a going forward basis? But we have to help them. It's incumbent upon us, I think, to do that additional research and economic research, okay? We have to do that, the industry and economic research, to help them. It's an additional step. It's not just pull a report and, some people just drop a report verbatim in a economic report verbatim in their reports instead of just finding what's germane, et cetera. We have to take the extra step and perform more due diligence, I think, to guide the client, to make the right.
Oh, absolutely.
Because anything that we put in our report, we've got to be able to withstand cross-examination. And you have to think about that as you listen to your client telling you his or her thoughts on where the business is going. How credible is it? And will you, as an expert witness, be able to put up a straight face on the witness stand and say, this is believable?
Yeah, but another issue that's more relevant too in a divorce case is because you may be representing the non-business spouse with no access to the theory or thinking of management. So here we're talking to the client who has no clue at all, and it must rely on us and our judgment. And it's almost like throwing a Monte Carlo analysis into projections.
No, I disagree. In that case, Alan, I'm going to ask counsel to depose the member of the management team that has the information that I need.
If you can get it through deposition, terrific. That's great.
Right.
Yeah, but Alan, you raise a great point. If you are representing, if you're assisting, I should say, the spouse who is not the business owner, and you can't get projections sufficient to use DCF, where do you go to in terms of the method to utilize?
That's why I'm asking you. You've got the answer to that.
All right.
But really, it is the problem in a litigation case.
No.
It's one thing when you're doing an estate or a gift where you can deal with management directly, but in a controversy, and particularly in family law, you don't have access to information or to people, and there's budgets that constrain you as well. I'd like to get the panel's view of what do we do, because we have to do the projections. We have to create them. That's what I was saying to David Witherspoon, that we can't rely on management to give us good projections. We've got to create them, but then we've got to determine probability of each of these. And Cheryl's point about all or nothing, and in the middle, somewhere we've got to come up with something that is credible, because we
Alan,
all know.
Don't you think, though, if we're the ones who are preparing the forecast, then we're valuing our own work. We have to get input with management.
There's a risk.
We have to get them to sign off. And I think that's why I was saying earlier, I think more than ever before, a representation letter will help bring management into the picture. And they say, okay, if I'm signing off on this, then I can't lie.
Hopefully. That's fine.
Yeah.
That's only if you represent management. If you're representing the out spouse, the non-business spouse, without access to information, and while the deposition, the discovery process is our tool, I've been there too many times where, I've been locked out of the business. I've been lied to at deposition. I've not been provided with documents. I mean, that's the real world.
Yeah,
and I think have to come up with a number.
I think as expert witnesses, we're going to have to, put our big boy pants on here and recognize that there are lawyers probably licking their chops right now, hoping to get us on cross-examination, just to say, what do you mean you didn't even talk to management or ask to talk to management about the impact of COVID on this business? And yet you're going to tell the court what it's worth. I mean,
well, let me
if I'm a lawyer, I am salivating on some of these cross-examination potentials. Here's what I think, though, that as a group that we need to do is that we need to insist that our counsel that we're working with, particularly if we're the non-asset, representing the non-asset holding spouse, we need to insist that our counsel explicitly request that we be able to interview management. We have to. And not just a 30-minute how you doing type of interview. I mean like a full-on sit down with 4, 5, 6 hours and interview the heck out of them after you have reviewed their historical financials and any projections, specifically to ask these questions. And then if they refuse, then I think you've got a leg to stand on that it's their fault, not ours.
All right, gentlemen, let's move on. Great discussion there. So it's DCF, right? DCF is what we agree to be using for these specific times. All right, so interesting question here. This is a question with regard to the different relief programs. What are the effects of the relief programs on valuation, especially the PPP, the Payroll Protection Program, the Economic Injury Disaster Loan, EIDL, and other loans?
Well, as you mentioned, the PPP program is the big one, the one that has had a lot of publicity. And I think a lot of people requested PPP loans with the expectation that the debt would be forgiven. And there's been a lot of publicity, particularly about some of the smaller public companies and some of the larger private companies, professional firms that got PPP loans. And we're not as certain anymore that loans will be forgiven, particularly if the business does not suffer as much as one might have thought going in. So initially you have a liability on the balance sheet, but if you're doing a valuation from the date of the PPP loan to the date when you find out whether or not it is forgiven, you're going to have to quantify based on your own knowledge and reading the likelihood of forgiveness, and that could affect the value of the company by some millions of dollars. And another uncertainty there is it is unclear. The IRS position is that you cannot deduct expenses paid for by the PPP loan. There's a movement in Congress to undo it. So when you're tax affecting, the uncertainty there is going to be around.
Yeah, and it's going to impact
the hard 75% rule of the PPP proceeds have to go to payroll.
Yeah.
Well, but one of the issues that's coming out is how are we measuring payroll? Is it as the law is currently written from the date that the funds are dispersed, or is it from the time period that your employees come back? And what if you're a seasonal employer and the funds are dispersed out of season?
And there's another new wrinkle with regard to if you have people that are off and you bring them back part-time, there's a certain amount of full-time that you need to have. And if you then bring them all back by June 30th, is that considered a sham of what you were doing before to protect your 75%? So there are a lot of answers that they haven't, given us yet to assist the clients.
Yeah, I agree with everything you all just said. I'd add one more sort of wrinkle to our futures here of assessing deals that are done now that make their way into deal stats or anything like that. How are their financial statements in those years impacted by PPP? Are people going to recognize it as revenue? Is it going to be recognized? And I'm talking not GAAP. I'm talking how do real world small businesses recognize this stuff on their financials that go into deal stats. If let's take a relatively non-impacted company, but they did go take the PPP money, and so they got effectively 2-3 months worth of payroll for free, and they were otherwise totally unimpacted by COVID, and the IRS forgave their loan, and they ended up selling the business. And that transaction goes into deal stats, and it shows they recognize it as revenue. for some reason on their internal financial statements. Well, now their profit margin looks a little bit skewy, and their valuation multiples are also a little bit, quirky as well. So there's going to be some longer term impacts of this stuff on some of the databases that we use as well, that really it's not going to impact us for months, if not even a year or so. But I think we should all keep an eye on those things as well.
But when it does affect us, it's going to affect what we do for years to come. We're going to have to think back when we see a transaction, for example, in the 2021 time period. Do we automatically throw it out?
Yeah, or
It's
just
a
deal
very
stats out of
pivotal-
field.
There's
It's
another-
a very pivotal time in our valuation lives. It really is.
There's another wrinkle here, and that's financial analysis, because you could take a PPP loan and treat it as a loan, treat it as debt, and you're borrowing that money at 1%. You're then taking a deduction for all your expenses in the current year and carry that back. You can go back 5 years and get a 35% refund on your prior year taxes. So there could be a lot of other financial issues here that affect the value of the business. Also, you don't have to pay payroll. You can take that money yourself as the owner of the business, when you couldn't have done it otherwise, when you had to purchase or to hire those people back. There's
So
a lot of
Alan,
other issues.
Alan, when we normalize, should we be normalizing all the PPP and other avenues of help from the governments? Because as an extraordinary occurrence.
Perfect. A good analysis. Very good. Because when you're trying to make a projection on earnings, what are the stabilized earnings of this company? What is its earning capacity? And you have all of these additional things that are extraordinary. Yeah, how do you treat them? And I agree with that point.
I think normalization is something that we're going to have to consider long and hard with all of these going forward as well. And to what Mr. DeJong was saying, it actually has made our job much harder.
Well, the
All
thing
right.
with normalization, guys, hold on. We can't normalize it now because we're going to artificially inflate the value of a business that could be on life support.
Yeah, I agree with Cheryl.
Comes back.
Yeah, I completely agree with you, Cheryl, on that. And I don't know, Ron, that it's necessarily what the type of normalization you were talking about. Like, you can't normalize out the impact of COVID or normalize out PPP or triple P in any way. But when you take a look at normalization adjustments in a time frame like this, especially if you're relying on the DCF method, the normalizations on historical financials are going to almost be moot. I mean, who cares, right? The real question is, what does the DCF look like that management's putting together? I think if we get the cash on cash mentality again coming out of the DCF, the concept of the normalization adjustments goes away, because management's financial forecasts should be normalized, to what the business is expecting. So, but I still think some of this data is going to linger in the databases that we use in the future. We may even just get to the point where we just have to say all data from 2020 is just toss it, because there's, I'm talking in appraisals when we do in 2022. I just think we're just going to throw away 2020 as a worthless year from comparability perspectives.
Are you talking about the deal?
But I just want to point this out, David, that I'm seeing, because of the constraints of people trying to survive both personally and business-wise, they are paying a lot of the family expenses out of the business. And a lot of small business run it that way as one checkbook. And it's going to be more effort on our parts to pull out the personal expenses. So it's going to take time, possibly, if we see some accounts that seem to have grown, all of a sudden we have to look into it. That's kind of what I was referring to.
Okay, yeah,
Well,
agreed.
another thought, and then, I'll be done on this topic. If management is able to quantify the bump or the crater related to this economic event, then they should be able, at a later date, they should be able to help us with that forecast or projection now, if they're able to identify what those costs will be or the impacts will be. It's just something to consider in the future. How are they going to tell us to help us pull that information out?
Sheil, next question.
All right. Well, thank you. Next question, which is in regard to M&A. Now, we know the current situation in the market is very difficult. Buyers are reluctant to buy.
Mm-hmm.
So what do we do? Do we need to increase the discount for lack of marketability to account for that?
I think
it's
the
going to be
answer,
based on industry specifics.
yeah, is generally yes. But if you have a beer and wine store, for example, where it's been found to be an essential business, or a gun shop, though they have higher revenues. Technology is doing well, but a majority of situations, I would expect I'm going to apply a larger DLOM until conditions improve.
Mm-hmm.
Yeah, and I spoke with several good friends of mine who are in the due diligence world, because they're sort of the leading indicator guys on M&A activity out there. So, what they're telling me is that the private equity groups and the venture capital firms, if they basically went radio silent right around the end of February, were largely dormant in almost all of March. But by the time April came around, they were already calling back up and have shifted their focus to focus on acquisitions that will round out some of the negative impacts of COVID in their portfolio of companies. And so they're looking at, what are the types of companies that are cash flow positive, even in this, with the impacts of COVID-19. There's plenty of dry powder out there. There's lots of cash still in the private equity funds and the VC funds out there, but they are shifting their focus to SaaS companies and other types of companies that have good cash flow models that do not require face-to-face interactions with individuals. And so I agree with everything that was previously said. I think DLOMs will go up for companies that are not sellable right now, because you effectively have to assume, if you think about like affinity put option model, you have to assume that your expected holding period is going to extend out. Maybe it's no longer 6 months to a year, but now it's a year to 2 years for a liquidity event. And volatility and equity volatilities have certainly gone up as well. So, just by a simple affinity put option model, you're going to end up with a higher discount for lack of marketability. I think in times like this, affinity put option model is to determine your DLOM is much more justifiable than just relying back on the old discount for lack of marketability studies. So that's sort of my 2 cents on that.
The problem's going to be, again, is how do we decide what that extra DLOM is going to be, and the reasonableness for that number.
All right. Next question. Is the temporary decline an indication of anything in regard to value as of now?
Define temporary.
Yeah, that's it.
Well, yeah, that's a good
saying
question.
Third quarter is what they're saying. It's going to start coming back. Question is how much.
How temporary is this going to be? We don't know yet.
Right.
Yeah.
Well, not only that, if we see it this morning, specific states that are opening up in specific areas in their states. So it's going to be very not only industry specific, but state specific within, because you may have a I don't know, a Macy's in the Midwest not being able to open, and the one in New York City not being able to open.
Right.
So it's those kinds of things we're going to have to take in consideration.
And this is the whole point of the discounted cash flow method, is to explicitly forecast how deep and how long that impact period is. It's to define temporary effectively, right? So
temporary in quotes.
yeah, and I think we've already sort of beat it up a little bit, but very few companies are not going to have an impact. I think you just have to do the DCF to sort of see how deep and how long.
And sometimes the impact is going to be destruction. Can you imagine now valuing a business in an indoor shopping mall or retail business? No.
Yes,
it's going to be very hard.
Easily.
And you may be using an adjusted net asset method if your philosophy is that is the lowest a business can be valued. You may very well, when you use a discounted cash flow or any other method, come up with a number less than what you get using an adjusted asset method.
Yeah,
that's a floor value.
To use your shopping center analogy, I was reading today where a lot of businesses that are in the malls are asking for deferrals as much as 6 months. Meanwhile, the shopping centers themselves have huge debt that they can't defer, and that is going to cause similar problems, if not more so.
They'll all be filing Chapter 11. Like so many shopping centers are going to be filing Chapter 11 for that very reason. They have no income. They have huge debt service. So
yeah, help the government, help reorg the period and get through it. You're right.
It'll give us a lot more work to do,
Willing to get paid for it.
Yeah.
Can they pay for it?
Next question.
Phew.
What is the likelihood of more earnouts for sellers who are going to be looking to sell their businesses?
And will they increase in time?
Even before COVID, we were seeing a lot more earnouts. I do a lot of business transactional work when I'm wearing my lawyer hat, not my valuator hat. And both in terms of professional practices and businesses in general, there's been a movement in the last several years to earnouts. Most sales of CPA practices have earnouts, and I think this is just going to accelerate it. The uncertainty going forward, the seller will get a piece of it if it's good, and we'll get a far lesser piece if it isn't so good.
Yeah, and I think it's GF data, or maybe the Pepperdine studies, I can't recall, has some really good data, historical data on the number of transactions that have contingencies in them, like earnouts. There's some really good data out there on that stuff. And I think absolutely makes sense. If I were a buyer, I think if any of us were buyers right now, we would be looking at it and saying, well, yeah, I mean, I'm not going to pay you 100% cash when there's so much uncertainty out there. Anytime there's increased uncertainty, there's going to be more earnouts and more contingencies in the contracts in general. But there's some really good articles out there. I think GF Data did a nice one that talked about how more stringent contingencies in the terms of M&A deals is a good leading indicator for future declines in multiples being paid on deals. So I'd recommend people doing a little research and reading on that stuff as well.
Okay. Let's talk about disclosure. Do we have to disclose that we did consider the impact of COVID-19 on our valuation report or not?
Yep.
Yeah.
Next question.
Doesn't that depend on the valuation date?
Yes,
It,
yes,
it
but
depends on the option of the valuator.
All right.
Yes.
well, if it's within the current time frame, the answer is absolutely yes.
Right.
Yeah,
Yeah.
but if you're doing it as of December last year, yeah, my opinion is that we follow the AICPA advice, and that is to disclose in a footnote or in a separate comment. I mean, to ignore it, I think, is wrong.
Right.
And so, I mean, I'm thinking, I like the language in the toolkit. I like what they've done. So I would go with that. And that's what our standards do provide for, that if you're going to disclose, then you just do it as a separate.
I'm just trying to imagine a judge or a user of our report looking at it, and if they can't very clearly determine whether or not this appraisal considered COVID or not, I think it just diminishes the value of the report. So I just don't know why anybody wouldn't put it in there. Yes, this report explicitly considers COVID-19's impact on this business, or this is a pre-COVID-19 appraisal and there's no impact considered.
Right.
That just seems so fundamental at this point.
I think as a practical matter, you know, we have to consider also what our obligation is to provide a real world touch. But on the other hand, it's inferred, I would think, that, you know, our research considered it, but we do need to, I think, as Alan said, explicitly state, yes, we did consider it. You know,
Let me read from the toolkit. The question is, can the valuation expert disclose a subsequent event in a valuation report? The answer, yes. That it's presented the informational information only.
Correct.
And that the event doesn't affect the conclusion of value. I suggest inserting a paragraph at the end of your report, or as I say, in the assumptions and limiting conditions.
Or an entirely different section of your report, or in an entirely separate document.
Yeah, but not in the report itself.
Correct.
So it feels like, you know,
Correct.
you considered it. Yes.
No, it needs to be absolutely clear that that this thing happened and I didn't consider it in coming up with that value, but you need to know about this other thing, and I'm not going to tell you what the impact of that thing might have been.
And you come to a very good point. If you are trying to do that, that's a whole other engagement.
Correct.
Oh, yeah.
Yeah.
But you all raised some very interesting points, and here is kind of a corollary to it.
Mhm.
Under Maryland law, in matrimonial cases, the valuation is supposed to be as close to trial
Right.
as possible. We have valuations sitting on the side that we did with December 31, 2019 dates, and some of them even earlier. And of course, now the courts are going to be backed up as they're shut down in Maryland to the 5th of June. And trials will be some months before they resume. And if you were scheduled to go in April, May, and June, it may be 2021 before the case is called to trial. If it isn't resolved, we're going to be doing a lot of valuations over again. And again, depending on the industry, many of them are going to have significantly lower values.
Yeah, and we're going to get asked why we changed from a capitalization of benefits method to a DCF too.
Yeah,
And
also,
why we ignored
future.
market multiples. Yeah,
Well,
sorry.
we'll have
Remember what you all did after September 15, 2008. So take your mind back there a little bit. It was industry specific. We had similar problems, but like Mr. Weatherspoon said, and all of you, we really need to get into the numbers, really need to do the work.
in the future, we'll have more information about what actually happened. So
Yeah.
We do have a court system that is closed, and they're talking about a year or 2 years just to get caught up. So it could be quite some time before we get to testify, in which case we'll have more information about what the effect is. But David's right, you're going to have to do another appraisal.
But if you're doing one in Virginia, where you look at the date of separation and doing the valuation, business owners are going to be in a different position because they're going to be stuck with higher valuations done as of the date of the separation, even if the case doesn't go to trial for a year or two.
Yeah, there's no way that doesn't get readdressed, I don't think, by either the Virginia legislature or Virginia Supreme Court, because there's just no way the dislocation in values between the date of separation and the date of divorce when financial awards are given can survive that. You know, I mean, people just file bankruptcy, you know, because there's no way the business or their personal net worth can provide the non-asset holding spouse values based on pre-COVID values when the business may be dead or barely surviving.
Yeah, the courts have a lot of discretion in Virginia as well.
Yeah, they do. Yeah.
It's not going to, I don't think that's going to be the issue, but the measuring date is the issue right now. But I think in a practical sense, they're going to adjust for it.
Yeah, I agree.
All right. Next question. What should we do with the pre-COVID-19 forecast if we get that from our clients? Do we discard them or do we have to?
Again, it depends on if the valuation at December 31, 2019, then we're going to use it. If it's going to be post that period, and now we're into March, it's a whole other ballgame.
Right.
Yeah. I'd like to pull out my Ross Perot hat. I recognize this is all written backwards so nobody can read it, but you know, this is that sort of, you know, traditional line that I think a lot of us may use in economic damages cases or business interruption cases where you have, you know, sort of the financial forecast that management had before COVID, and then the red line is the impact of COVID over time. And, you know, you're net present valuing those two DCF models, and the delta between the two is the present value of the shit, you know, the gap in there, right? Those financial forecasts from before COVID may represent sort of where do you expect yourself to get back to at the end of your DCF period now, right? So, you know, Ron, I think earlier you said, how far out does management need to go to get run their DCFs?
Right.
I think if they had a 5-year forecast, and I can take a look at that, and now they give me a new financial forecast, I can take a look at that and say, well, have we gotten back to quote unquote normal by the end of your DCF now? And, you know, or do we maybe we just never expect to get back to that full level. But if we do, your forecast may need to go out further until we get back to where you were before 5 years from now in the future in your DCF.
Yeah, that's where I was talking to you about. We can call it, I like your graph, I'm going to call it the frying pan graph.
Yeah. So I think that's going to be a big thing for those of us who do economic damages cases, you know, with or without scenarios or but-for scenarios. A lot of us are probably relatively familiar with doing this type of analysis. This is basically just a huge, you know, but-for, you know,
right,
or with and without. So
that's kicking everybody in the butt.
Yeah. And I think the next thing I'm going to use those, Ashil, the pre-COVID financial forecasts, is to take the pre-COVID financial forecasts and the post-COVID financial forecasts and use that as my guide with my conversations with management. Yep. So I've already started developing a whole series of questions. You know, are revenues down because customers can't get to your good or service? Or are revenues down because you're projecting that there will be a lack of demand for your service and, you know, lack of demand overall? Are your cost of goods sold margins or your gross profit margins, are they different because your cost of goods are actually higher, or because you're having to put your product on sale in order to, you know, try to get the market back to you? Are your operating expenses, how levered are your operating expenses, meaning how much are fixed costs versus variable costs, and how does that impact my assessment of your risk in a COVID type of world? I'm going to use the pre-COVID forecast and the post-COVID forecast to make sure that management's actually thinking through all the issues they're going to have to deal with, and to help assess whether or not management is actually has good capacities to deal with this type of environment or not. So I think they're going to be very valuable, but they're not going to be used in my DCF.
David, you raised some very good questions. And ironically, just before December, my client in North Jersey who delivers the bottled water, actually he bottles and ozonates the water himself, but he was buying the bottles and the filters out of China.
Yeah.
And he had to place a huge order, like a, what are they called? The trailer, a small trailer load, 3-4 months in advance. And I said, you've got to start looking closer to home, because the travel expense is so large. Look towards anywhere from Mexico to United States to Canada, see if you can get the same here. So companies are already starting to do that. And then underneath what you were saying, has the supply chain been disrupted?
Right.
And other questions like that, because we're in a brand new world with some companies.
Yeah, you're spot on, Ron. Spot on.
Hey, David, can you put your little frying pan up again?
Oh, yeah.
There's
See?
a question, so I need to see that. I just noticed a question down the bottom there. Ron, didn't your article
Q&A?
also, while she's copying that down, didn't your article have a page and a half of suggested questions in there? Just a little
It
plug
did.
for you?
Yes.
Yeah. Okay.
Yeah, and I'm more than happy to make that available to anybody. We probably just say it at the end, but my email address is ron.rudick, RUDICH, at Bravo Victor George, BVGLLC.com. And I'm an open book. Whatever I can do to help you, I'll be more than happy to send it to you.
Yeah, that's pretty much all we do with the forecasts, I think, is ask management, what do you think is going to change? And that helps you get a handle on what they're doing, how they're adapting, if they're adapting, what does their future look like? And, to David's point, what did they miss, if anything?
Mm-hmm.
All right. Thank you. Next question. Can we really provide an opinion with a reasonable degree of certainty, or do we have to hedge on that?
I want to get back to that, if I may. Excuse me, Cheryl.
Sure.
Don't forget, we're able to give a range of numbers. We don't have to cite a particular number. And if we feel most comfortable in this economic consternation, if you will, give a range.
Yeah, per the standards. You're absolutely right, Ron. NACVA standards specifically say you can provide a single number or a range, right? So there's nothing within NACVA standards that requires us to give a specific value. However, there's the question of use of the report, and your client may tell you it's worth nothing to me if you give me a range. I have to have a single number. But those instances where a range can be useful, right? I mean,
right.
Litigation settlements, a range
absolutely.
of value can be very useful. M&A consulting, a range of value can be perfectly good. Where it's not so good, gifting, right? I mean, they have to put a single number.
No, that's understandable.
Now's a great time for people to be, if they're C corporations, to be doing S elections because values are down and they get to pick a date. But again, you have to come up with a specific number for all the assets. So I think you're right, Ron. In instances where a range is an acceptable result for the client, I think it may be a really good idea, frankly, to do a range. but there are just so many instances where you have to come up with a specific number. Even if you could give a range, you just practically you have to give a
Here's
specific.
an
I'm just saying,
alternative
Don't forget about it, that's all.
if you want to hedge, and I've used this at least once on the witness stand, although I don't remember the circumstances. It involved a degree of uncertainty. Now, you must testify to a reasonable degree of certainty, but what if you say on the stand, we're in 2022 and COVID cases have declined? Can you testify subject to there being no recurrence of of COVID with a reasonable degree of certainty? The value of business XYZ is $1.5 million. Can you put a hedging condition? I have done it on the stand, and it has been found to be testimony within a reasonable degree of certainty.
We put that in every single one of our reports, that I always reserve the right to amend my valuation or anything like that should additional facts become known or knowable to me, or other things happen. I think that's implicit in any valuation, and if it's not explicitly stated in your reports, I would actually highly recommend. I wouldn't pick COVID-19, because if a meteor hits Baltimore City, our valuations are probably affected too. So
In some places they might go up.
That's true.
The issue that David was referring to is critical. Our standard of testimony, expert testimony in Maryland require, and it's nationwide, it's not just Maryland, but you've got to have a reasonable degree of certainty, of professional certainty. You must say that. Now, you can say that and still have reservations in terms of, in your report, you can actually say it could be a range, but this is the value that I believe to be to a reasonable degree of professional certainty. You have to say that. If you don't say that, then your testimony is subject to speculation. And once that word speculation gets into just into the case, your credibility is all gone. And
Right.
so you cannot, on appeal, it'll get reversed. So you can't have the speculation. Maryland law is got a lot of history on it, that it requires that professional degree of reasonable certainty, or the reasonable degree of professional certainty. So we have to do that. Even though we can have a range in our report, you still have to come up with a single number. And estate tax is that way too. So.
Yeah.
All right, next question. What additional documents should we add to our usual documents request to take into account COVID-19?
I think it should be specific to the business and the industry that it's in. And that will lead us down a road for more questions.
Yeah.
And like David was saying before, a critical analysis with management, and hopeful that they're more honest with us than ever before.
Yeah, definitely. And, take the case where you have, a manufacturer or something like that who has a customer concentration of 60% with one customer. Before, my interview with management might simply say, how's your relationship with that customer? Have they expressed any concerns about your product or service? Now I'm probably interested, is that customer going to survive?
Right, exactly.
So there can be lots of questions related to revenue breakouts by customer, revenue breakouts by customer demographic, to see if there's a bigger impact in one segment of the business or not. It's all about trying to figure out the major thrust of the impact of COVID in the business. Like, how is COVID actually manifesting its damage to the business, or its upside to the business? And you're going to need documents to support that in your work files.
A couple of specific things that you're probably going to want, if 2020 is something that you're going to be looking at, and even if you use DCF, you're going to want to understand 2020. Most of the time, I only ask for the most recent interim statement. I think you're going to want to look at every single month of 2020. And obviously, you're going to want all information regarding the PPP submission. When you did a submission, you had to state under penalty of perjury that you believe that you could be adversely affected, and you want to see what information went into that application and the attachments that were given to the bank.
More than ever before, David, I have been using, you say, an interim statement. What I always ask for, and have for many years now, is a trailing 12 months. So this way I'm picking up some of the old and some of the new. But what we learned in school, ages ago, if you had an interim statement, we're obligated to normalize it for the future, 12-month period. And then that removes all the guesswork if I use a trailing 12 months. And I think that would behoove us to, we haven't been using it, to give us a snapshot of what happened and into what's happening now, so we can compare that to the past and give us an indication as well.
Great answer, Nate. Great. Okay, next question. Should we use, I think we already talked about this, should we use ranges of values instead of single number to account for uncertainties?
Yeah, we covered that.
Right, we covered that already. What are, in a recession,
Christian, Maria, please dial extension 2524. Christian and Maria, please dial extension 2524.
Go ahead, Ashil.
Okay,
Yeah.
All right. What are, in the recession, the historic recovery periods?
Yeah, so this is David. I'll sort of jump on this because I had not looked anything up on this previously, although I've heard lots of economists talking about it over the years. Wikipedia actually has a really great article titled List of Recessions in the United States. Kind of right on point. 47 recessions in the history of the United States dating back to the Articles of Confederation. And then they break it out by sort of era, like early recessions, like 17 and 1800s, free banking area in Great Depression recessions, and then basically post-Great Depression and then post-World War II. And what's interesting is that the more modern recessions seem to be better managed, right? They last a shorter period of time, maybe on average like 10 minutes or so, or 10 months or so. And the time in between recessions is typically like 55, 57 months, something like that. But the time, our last recession, and it's probably hard for a lot of us to believe this, was 10 years and 9 months ago, right? I mean, a full decade, more than a decade ago was the collapse in 2008, and coming out of that. But there is a group out there, nonprofit economic group out there called the National Bureau of Economic Research, or NBER. And they track not only the recessions and the duration and the coming out of it, but how deep the recession was. What was the impact on the GDP decline from peak to trough? And most of the recent recessions in the modern era were like, 2-3%. There's stuff like Great Depression was 26% decline in GDP. There were a couple more that were like 10 and 12%, but the vast majority since the 50s were all between like 1 and 5%. Currently, the economists that I've been looking at have been thinking that this is going to be a 10 to 25% GDP hit, maybe 10% Q1, 25% Q2. And that puts it in the realm of like Great Depression impacts in terms of its severity.
Mm-hmm.
Now, maybe not its duration, but its severity could be that extreme. So, you know, you asked the question in general, you know, how much of an impact, or, you know, are we going to look at historical recessions? I think it's going to be tough to look back over the last 60 years and find a comparable recession. And the markets are so different. I don't think you can really use the recessions before that. This is, I think it's just a different animal that we're dealing with. It's not a financial recession like the real estate one in 2008, 2009. It's not, you know, coming out of a war. It's none of those things. It's just a totally different thing. So look back at them, study them, absolutely. Is there much? I think you know, I don't want to prejudge it, but I just don't know that we're going to glean much from historical recessions. Again, my 2 cents for now.
Well, you're right. Even if we were in any of those in the past, we would still not know when the end would come. And you hear that today on the news all the time. We just don't know.
Yeah. Unpredictable. Yeah. All right. Next question. When recasting or normalizing the financial statements, should we consider the impact of COVID-19 as a non-recurring event? I think we also talked about that a little bit. But
We did touch on that a little bit.
Yeah.
Goes back to David's frying pan chart again. It's got
Yeah.
the runway for the anticipated recovery. But again, can management articulate to us exactly what is going to change between now and then? I mean, the business model may completely be turned upside down, right? Between now and where they think they're going back to.
Mm-hmm.
So, you know, what is it that you're going to normalize a few years out is the question. Or is this
I think,
normal?
yeah, the only thing I think I'd add here, Sheila, I think we already covered this a little bit, but I think the only thing I would add is that for those companies out there that don't really feel like or maybe they need help developing financial forecasts that we would use in a business valuation, I would say that I've been pretty adamant over the years of insisting that any consulting engagement related to helping management compile financial forecasts is a completely separate engagement from my business valuation.
Absolutely.
Different engagement agreements. It's listed as a consulting engagement.
Yep.
And at the end of the day, management represents to me on the business valuation engagement that those forecasts are their forecasts, not mine. Right. And so I don't know if other people have different opinions on that, but I've been very adamant over the years that that's the way.
I think you're absolutely correct, David. Absolutely.
Well, there's a major conflict of interest, as you pointed out earlier, that if we do the projection and then we do the valuation based on our projection, it's our value. And,
right.
you know, that's
we're valuing our work.
Exactly. You know, your point, you definitely have to have a separate engagement for that purpose. I'm just talking from a practical side of litigation work when there are no projections. We're not representing management, and we've got to make some future an analysis of future cash flows, and that's the issue that I'm concerned about is how do we value the future? So I mean, there is no right answer. It's just the probability of recovery and the amount of time and
right.
You know, cash flows that we have to value.
Mm-hmm. Okay.
Well, you know, I hate to use Monte Carlo as an illustration, but maybe we should do some random sampling and projecting using computer models and just see what that comes up with. Although I hate if you
mentioned that this week.
Well, if you go into court and use the word random and chance, judge is going to say, well, that doesn't have a lot of support to it.
Yeah.
All right. Thank you. Let's go to the next question. And I think Ron touched on this question as well. What industries will be more and least affected by COVID-19?
Well, the list that I put in my article, most affected, as we know, airlines,
Right.
travel agencies, hotels, local trucking companies, resorts, gambling, cruise ships, which may never recover, small businesses and retail, other transportation businesses, liquor stores, movie theaters, live shows, concerts, and Broadway, restaurants, oil and gas production exploration, oil production exploration equipment providers, oil and gas distribution, new home building, and business valuations. Some have been postponed. I had 5 engagements at least out there, and people said to me, wait. Least affected, I'm finding companies making masks and other items for COVID, grocery stores and supermarkets, food processors, long hauling trucking, environmental waste disposal, drugstores and pharmacies, banks, funeral services companies, funeral transportation services, medical devices, hospitals and surgery centers, emergency services, real estate development, energy-related businesses, utilities, investment banking and brokerages, and for business valuations, bankruptcy, litigation, divorce, ESOPs are still hot.
Don't forget the toilet paper manufacturers.
Nice.
Yes.
Well, the divorce business is going to be good after this is over. There are going to be a lot of divorces after people spending 8 to 12 weeks perhaps together. And if you could divorce your kids, it would be even bigger than that.
Alan, I went to Costco yesterday. This past weekend, they got a huge shipment of toilet paper.
Good. I've got an order on paper towels that has been delayed 3 times. So Quill owes me some paper towels.
I agree. I agree with a lot of those thoughts and a lot of those industries. I think some of them do require some thinking about the verticals within those industries, and maybe even the separate segments within those industries.
And their supply chain.
I'm sorry.
And their supply chains.
And their supply chains, absolutely. So, on the real estate side, I think it's really interesting to look at the difference between hospitality, commercial real estate, industrial real estate, multifamily, and self-storage, because the different impacts in those different industries are extreme. Not to mention, of course, malls and shopping strips. When you look at, let's take, for example, the airline industry, to the extent that airlines aren't building more airplanes, the entire supply chain vertically down from them is getting crushed. And same thing with some of the trucking fleets. Some of the verticals that supply car manufacturers and trucking manufacturers are getting crushed in the short term, but those industries always have a way of sort of bouncing back, because at the end of the day, aging of fleets is a real thing. And, you may not be replacing your truck this year, but if it gets a year older and has a little more wear on it, you're more likely to now have to replace 2 trucks next year, And so there's going to be sort of a slinky type of effect on some of these things in some of these industries. Mm-hmm. Oil and natural gas is another really interesting one. Yeah, the explorers are getting decimated. The transportation companies, kind of a mixed bag on whether or not they're too highly levered or not. But those master limited partnerships on the transportation side are very different than the exploration side. On a couple of areas where I took a look at is industries not affected much. I mean, positive or negative. And I had, software as a services as a sector just simply doesn't require face-to-face interaction. And so I've got a number of SaaS companies that I've been working with, and they are either not affected or they're greatly positively affected because people are switching over to use their software as a service as opposed to using whatever tangible service they may have used as an alternative before. So I think that's an interesting thing. But Ron, I think it's the right way to start thinking about this. Is different industries are being impacted very differently.
Yeah.
And you really have to think, down to the sub industry. Is that sub industry that you're valuing positively, negatively, or sort of neutrally impacted?
Ron, I heard you say liquor stores in the list of most affected. I presume you said most affected because sales are up instead of down.
Yeah.
Well, but I think in Maryland, I've seen some stores because it's not a necessary business to be open. They're closed.
Oh, no, they're open.
They're open.
Oh, okay.
They're open.
Ron,
Well, that's what I read.
Yeah, they're open.
Virginia, we have
Interesting.
frozen margaritas to go.
All right.
Yeah.
Interestingly enough, both Davids, my son is a network engineer for a cybersecurity company, and their largest client is Disney, and Disney is getting crushed, and their business is down because of it. So,
well, but not all of Disney.
no,
Disney
I understand.
Plus.
No, I understand.
Yeah.
But you're talking about large companies that are diverse. They have certain segments of their diversity are getting hit, while others, like even Zoom that we use, and the using the internet just to see new movies that they can't put in theaters and things.
Yeah.
So they're charging a little less and sometimes a little more, but they're trying to at least move along. But it goes back to what we said over an hour ago. We really need to look at each business within each industry, within the state and locale, and what's going on.
Yeah.
Okay, let's move to the next. We got 15 minutes, I think, of less than 15 minutes left. Time is going very fast here.
I told you we could talk all day.
Yeah. All right. One question that I think we touched upon a little bit at the beginning. In determining the discount rate, how does the company-specific risk how does this company-specific risk be considered in light of COVID-19?
Well, I think we can just cover it in one quick. We just need to be ever thoughtful of it. Alan brought out that I was mentioning be careful about double dipping, and Alan was giving his thoughts. Yes, there is company-specific risk, but also we have to be careful about the cash flow analysis, and it may not be double dipping, but both need to be significantly stated as best as we possibly can. Did I say that right, Alan?
Sure, thank you.
All right.
So next question.
Next question. In a divorce valuation, what are the issues related to the date of trial?
Yeah, I think we talked about that one as well. Depends on your state. Yeah. Mm-hmm.
It's a moving target.
Yeah, right. What are the effects of actual earnings?
Yeah, I think this one and the next question are very closely related as well, as Sheila. Yeah, so this is an interesting one when we get into the work that we do in the world of alimony, child support, the rest, where they're decisions that the court makes based on the earnings potential of the two divorcing parties. And I'm in the middle of a divorce case right now, and the lawyers don't know how this is going to work out either. But the husband in this case, we'll just say he makes about $200,000 in base salary a year, but he gets substantial commissions on real estate transactions. And, substantial meaning like $400,000 to $600,000 a year in terms of average commissions over the last 10 years. Well, the real estate deal world is dead. So is his earnings potential for alimony purposes really $800,000 a year, or does it get crushed all the way down to his base compensation because that's not contingent on anything? And then what happens if a year from now it shoots back up, or maybe it takes 2 or 3 years for it to shoot back up? Should child support or alimony be modified? And we were talking about before, there's a process in the courts for that, but is that, that process in the courts hasn't been a dominant factor. And I think we're going to, if you're talking 20 to 30% unemployment right now, in terms of real numbers, this may be a huge thing that the courts are going to have to deal with, is sort of recycling these cases to reassess alimony.
I have an observation here I want to share. That we do we wear two different hats frequently. We do evaluation for marital property. We also do litigation support for the alimony and child support. And they're mutually exclusive from our discipline point of view, but from the court's point of view, they want us to give the court our opinion of actual income, for example.
Yeah.
And this word actual income is very specific, and too often they'll use tax returns, and a tax return has got to flow through on a K-1 that has nothing to do with distributions. It has nothing to do with the actual income available for support. And we need to point that out. We also, in our valuations, talk about cash flow. We need to be actual in our analyses. We can't be too hypothetical. And a lot of accrual accounting sometimes will misrepresent the actual income available. So I think we need to focus on what does the court need from us, and how can we provide good information for that particular purpose. And the actual income definition, in Maryland, we've got a pretty good case that Walker versus Grove that talks about actual income. But even so, we need, as experts, to analyze a business as to what is the actual cash flow that's available.
There you go.
Alan raises
the one who spins around. Yeah.
Alan raises an extremely good point. One of the toughest things in valuation where there is a flow through, in determining actual income where there's a flow through entity, do you use the income or do you use the distribution? We got a lot of businesses that are scared and are not going to be paying out huge amounts of compensation. They're not going to be doing distributions from flow-through entities at the same rate. So more likely you're going to use distributions than the flow-through income on the top line of the K-1.
All right.
I once wrote a paper about the 100% tax with a PTE, pass-through entity. So if a client makes $500,000 and appears on his K-1, and that's a misnomer for the court to see that. If he takes a $200,000 distribution to pay his taxes, and that's used as a receipt, but he pays his taxes, he's left with nothing. So what Alan was saying, and you were saying, it's important that we point that out. I also think what we've done in the past is still warranted now, that the living wage for the in-spouse who owns the business must be put on the return so that the amount that flows through to the bottom for cash flow and for value purposes are properly stated, and that which the courts won't pick up another higher number for alimony and child support. I think we still have that conundrum.
Okay, let's finish. We have our last one. We have 5 minutes left. We're going to ask this last question, and then we're going to proceed to your closing remarks. All right. So the last question here will be, what should business owners do to protect the value of their companies during this COVID-19 pandemic? What would you advise them to do to protect the value of their businesses?
I think very generically, it's a two-step process. Number one is cut your losses however you can do during this period. But at least equally important is position yourself for coming out of this period and doing the right things. There are going to be multimillionaires made by people who have descended into tough circumstances. So coming out
Are those phone stores open
is going
again?
to be very, very important.
Hey, there's somebody doesn't have their mic on mute,
Yes.
if you don't mind.
Alan, I have two rectangles open for you. One, your picture, and another one must be your office.
Oh,
And there, he got it. He put it on mute. We're good.
Okay, good.
Yeah, Dave, I think that's pretty much right. I've got a couple thoughts on this one. For me, it's all about cash conservation, and so that means minimizing every expenditure that you can to wait to the backside of this thing. Streamlining your operations for maximum cost efficiency, and this concept of operating leverage, making sure that you better at this point in time to have more of your cost structure variable expenses as opposed to fixed expenses. Meaning if you can shift salaried employees to temporary employees, 1099 employees, and the rest of it, that may not make you feel great, but if you're talking about preserving the value of your business, even if it's higher to pay them or more expensive to pay them on an hourly wage per unit sold, and therefore lowers your gross profit margin and your profit margins overall, it de-risks your business to a large extent compared to your competitors and may make it so that you can weather a downstorm better than they can. Obviously, as you scale up, you may want to bring some of those variable expenses back over to fixed expenses to maximize profitability. But in the interim period, you may want to shift to a more variable cost structure. Frankly, I hate to say it, but it's time to cut staff who aren't worth their salt. And nobody enjoys that process, but it's part of the economic process of capitalism. Lastly, then I'll shut my trap. Maximizing technology investments that can effectuate work from home as much as possible, regardless of your business. So, if you have a CFO or a controller or finance people, frankly, who are usually introverts anyhow by nature, more of them can work from home, even if the rest of your business does need to be on site and on premise. It may be that some of your corporate staff doesn't need to be, especially those who aren't leading from the front or leading individuals that need to have that physical presence. So I don't know if anybody else had any other thoughts.
Well, just to touch briefly on both David's points, doing the right thing means protecting your people, which is both your customers and your staff. Keep that, medical screening for them if needed. Stagger who comes in when. Maybe adjust your downtimes. If typically you take a company retreat in September, do it now. Okay, have a virtual retreat or something like that. If you shut down typically in July, shut down now and be open in July. Just adjust your time frames as you can so that these people can keep working. Just the cash flows. Obviously, they're important. There's a business continuity playbook that some of the larger companies have. That's a conversation we should probably all have with our smaller clients as well. I mean, look at their liquidity and credit risks, look at their cyber risks, especially right now. And you've got a lot of companies right now where their entire staff has shifted out of the factory or out of the office. You now have an unattended factory or office. That's a facility risk. You've got to look at that stuff as well. Check your business interruption policies also.
Make sure you have enough fire insurance.
For that unattended building.
But I think if our clients learn nothing else, what we do when we look through and scrub a P&L I think they have to remove the emotional side of their past successes and have expanded their expenses in a sense of creature comforts. They may need what all of you are saying, just to look at it line by line and see what they can cut and create that cash conservation, as Mr. Weatherspoon has said.
All right.
Mean and lean, right?
All right. Well, thank you so much, ladies and gentlemen. This is where we come to the end of this webinar. But before we leave, I would like each one of you to give a few minutes of closing remarks, few seconds, I mean. Yeah, before I turn it over to Jonathan. Thank you. So who goes first? The reverse order, Ron first.
Okay. We started talking about credibility and our independence and really getting into understanding the company and the industry. Don't forget your tools. Don't forget 5960. Understand what's going on. Ask more questions. We've discussed about making sure that you have a list of questions and insist on having that conversation with management. And most of all, please be an excellent listener, because the answer will provide the next question that you haven't thought of.
Thank you. Next, David Witherspoon.
I hope everybody found this relatively informative. Frankly, it was a lot of fun to hear what other practitioners out there are seeing and how they're reacting to all this. I know a lot of us, CPAs out there are within CPA firms. There's also quite a few of us who are effectively solo practitioners within CPA firms. And then there's a lot of us, frankly, who are solo practitioners. I think this time, more than any in the last 10 years, it really makes sense to reach out to your fellow practitioners and ask them for their thoughts on how they're handling things, talk about a specific case and bounce it around. There's too many dynamic factors with this, I think, for all of us to just sort of cloister up in our own offices. We may not be, getting together for lunch or cocktails or something like that, but we really ought to be reaching out to each other and bouncing ideas off each other for the good of our profession. So
Thank you.
That's it.
Thank you. David Dijon.
I'll conclude with two observations. Number one is I think we're going to see bigger differences in conclusions of value among our members, notwithstanding that we are all good valuators, but simply from choice of valuation method, the fact that you may be assisting the party who has the documents or the party who's having a hard time getting them, and different interpretations as to the effect of COVID. I think it's going to make it harder for counsel to resolve cases. And second, and very important to us, and it was alluded to earlier, are fees. I don't see how we can do valuations for the same fees that we have been charging. I think we have to be thinking 30, 40, 50% more to do the job that is required to produce our best product and to be comfortable on the witness stand.
And David, I hate to interject because I know we're on closing comments, but I'd be really interested to get your thoughts. Do you see maybe more cases coming up where the judge, both parties agree to hire a single appraiser, or a judge basically takes an appraiser from the bench just for cost purposes alone?
Absolutely. With an increased cost, the judges are inclined to push the parties and their counsel to agree on a single valuator. You'll see it more.
All right, thank
I'm
you.
already seeing that, David.
So next closing remarks, Sherry Hyder, please.
All right, well, again, David, to your question to David, I'm already seeing that. I've got a couple of those right now that are pending new court dates. But valuation itself, I don't think is really changing that much. It's, the amount of effort that is going to be required of us to tease out the relevant facts so we can tell the stories that need to be told does mean that the clients are going to have to understand that there's more time that this takes, which translates into a higher fee. But we also have to think about, is this client going to have the resources to survive, and just exactly how long their runway period, their recovery period will take? And their ability to return to the same operations model pre-COVID where they were successful, are they going to have that same success going forward? The way we frame those questions to them are going to be obviously, very sensitive to the people. But, we have to remember that none of us are as smart as all of us together. To David's other point, it's more important than ever, I think, to reach out to each other, not just to bounce ideas, but also the social connection that we miss by not going to the chapter meetings and whatnot. Just to continue these discussions, continue to flesh out what's important and the best technique and the best practice in this new environment. That's pretty much all I have. Thanks everybody for tuning in. We hope that you found this of value, and please stay safe.
Thank you, Cheryl. And last but not the least, Alan Zip.
All right. My comment really, I'll be very brief. And I believe that integrity, we've got to maintain our integrity and independence in what we do. We're going to be subject to a lot of pressure from our clients and maybe their attorneys and maybe others to come up with an opinion that maybe not what we believe is really credible. And I want to come back to that notion that we have rules, we have standards, and I would emphasize that we just pay attention to those standards and operate our practices and develop our opinions consistent with our generally accepted standards of value. So I want to thank everybody for participating as well. I've learned a lot on this group.
Thank you. Thank you so much, Alan.
It was great, Todd. Loved it.
Absolutely. Thank you so much, everybody, for attending this first state chapter webinar on COVID-19. We are the first chapter to be starting this type of event in partnership with the headquarters. So I want to thank all of you who participated and all those who signed up to listen to the debate, the discussions. Thank you so much, Jonathan. And I yield. Is Jonathan there?
Yeah, I'm
okay,
here.
Sure. All right. So you get the floor. Thank you. Appreciate it.
Oh, thanks so much, Ashil. Wow, what a great discussion today. I know I learned a ton, and it sounds like everybody else gleaned some great information from this. I want to thank everybody for joining this virtual town hall, and want to thank the panelists, Alan Zip, Cheryl Hyder, David DeJong, David Witherspoon, Ron Rudick. We'll be issuing CPE credit, 2 CPE hours of credit within the next 7 to 10 business days. So be watching for that. And I want to especially thank Ashil for allowing us to partner with the Maryland DC state chapter, and thank him for moderating today's discussion. If you have any questions regarding today's discussion, please feel free to reach out to me or Ashil or any of the panelists. And if you want to connect with the panelists, you don't have their information, reach out to Ashil and he can provide that to you. Hope everybody stays safe, stays healthy, and is kind. And want to wish everybody a great day, and we'll talk to you soon. We'll see you later.